Hello again, everyone. Welcome back to PwC's monthly barometer. This time for July, I'm Jonathan Westhead. In our last edition, we didn't have the updated number before filming. However, after updating, the barometer stood at +4. This month, it dropped 7 points, reaching -3, its lowest level since July 2016. In Luxembourg, real GDP grew by 2% in the first quarter of this year and by 5.1% year-on-year. Information and communication services, as well as commerce, were the main contributing sectors to the growth. The financial sector's value add stagnated somewhat compared to the last quarter of 2017, with the sector only growing 0.4% over one quarter. Real estate development was the main driver of the construction sector, which grew 1.3% over the same period. Improved economic conditions are expected to gradually strengthen underlying inflation and wage increases. We expect unemployment to continue to decline and to reach 5.4% in 2019. Looking to Europe, the Greek debt crisis is coming to an end and the ZEW index has plunged into the negative, reaching a level close to July 2016 when it dropped due to the Brexit vote. Industrial production also fell following 6 months of consecutive increases. While the ECB maintains that the outlook remains positive and projects a GDP growth of 2.1% for the year, followed by 1.9% for 2019 and 1.7% for 2020, and 1.8% inflation for 2018, it announced that it did not want to raise policy rates until July 2019. The euro weakened as a result, and markets were somewhat disappointed. On top of this, the impact of higher taxes on steel and aluminium exports to the US is expected to be marginal, but it still raises uncertainties surrounding a potential trade war. Our expert Zoe joins us now to tell us a little bit more about this. Zoe, as always, it's great to have you here. Could you tell us a little bit more about the situation?
Sure. Well, I think that the main risk we see is the US economy potentially overheating, which could have consequences for Europe. While recent tax cuts should encourage consumption and investments, and inflation acceleration could push the Fed to raise rates faster than expected, which could put highly indebted sectors at risk. Additionally, the term premium, which is the gap between yields on 2-year and 10-year treasuries, is at the lowest in the US.
Thanks so much, sir. Correct me if I'm wrong, but this could be a sign of a possible recession in the medium term?
Correct. However, it's a bit too premature for any sort of speculation surrounding that.
I agree with you there. Anyway, that's all the time we have for this month. Due to summer vacations, we'll be back in September. Thanks very much. See you then.